guys, so welcome back to another episode of the Property Source and Success Show. Today, guys, I want to answer a question that I see all the time in the property forums, Facebook groups, but actually this came from a mentee inside our mastermind program earlier last week. But to be clear, it's a question that I get from both new portfolio builders and experienced portfolio builders. And that question is, do investors always expect a discount when they are buying a portfolio? It's a really good question. And like most good questions in property, the answer is, it depends. Right, so in this episode, what I want to do is break it down. I want to break down what that it depends look like. So we'll talk about when a discount is expected, what numbers really matter to investors, how to think about your fees. Yes, this is very important, your fees, because it is imperative that you're not screwed down when buying a portfolio, or sorry, when selling a portfolio, because this is, speaking from experience, something that I had happened to me in the earlier stages. Wrong investor, right deal, got screwed on fees. So we look at that, and we look at how you can position the deal so that you don't actually lead with the price, but you're leading with the value. This is really, really important. And it's okay to have conversations with investors, and it's okay for them to know how much your services cost, but it's also only applicable for them to know that when they are fully aware of the value that you bring. So with that in mind, let's kick off today's episode and dive in. So, do investors always expect a discount? In short, yes, they do. Most investors will expect some form of portfolio discount, especially if you're buying multiple properties in one go. But this is where people go wrong, and I see it happen all the time. People think about the price. They think it's about the price. The reality is, it is not about the price, it is about the value. Context around that is, if the portfolio is already let and income generating, that's value. If the portfolio is already professionally managed, that's value. If the portfolio is already producing a steady cash flow from day one, that's value. If the portfolio has maybe a potential future upside, maybe there's a potential to refinance, maybe there's a potential to raise rents, maybe there's a potential to add significant value, that is all value add. So then the investor is saving time, they are saving effort, they are saving legwork, and in some cases, they are saving legal costs by getting it all in one kind of neat package. Now, in those cases, you don't need to be bartering and negotiating for a 20% below market value deal. So hell, hate the words below market value. 5 to 10% off the market value is often seen as quite fair in a portfolio buy, especially if the seller wants a quick exit, especially if their properties are in decent condition, especially if the yields stack as per your investor's criteria from day one. So don't lead with the price, lead with the value. What yields do serious investors look for? Well, as a rule of thumb, and I use this in both my own investing and when I sourced on behalf of other investors, for standard buy-to-let portfolios, you really want to be looking at anything from a 7% gross yield and above. That's really what you want to be looking for. In higher yielding areas, so that will be your Belfasts here in Northern Ireland, that will be your Liverpools, that will be parts of Manchester, that will be your Glasgows in North East England, then you'll likely see rents of 8 to 10% or slightly above. So that's what you can expect to look for. If they're a cash buyer, then they might slightly for a settle less yield if the asset is completely hands-off or it has longer term potential. Now, when you're pitching this to investors, and this is a pro tip, don't just say this is a 7% yield. Don't just say this is an 8% yield. Break it down for them. So include the current rent roll, include the gross yield, include the net yield after you take your letting fees off, your insurance fees off, your service charges, but most importantly, include the potential uplift if the property is under rented. Include the potential uplift if the property needs a refurb. Include the potential uplift if there is maybe significant value add, extension potentially. Show them the whole story, not just the Polaroid snapshot. This is really important, and all too often I see portfolio builders and deal sourcers and deal packagers, all the same thing by the way, but all too often I see them try to sell like snapshot instead of the whole storyboard. Paint picture for your investor. That's what they're paying you for. Painting the picture, painting the vision is what's going to get them excited about working with you. It's what's going to get them excited about investing in your services. It's going to get them excited about buying the deals. So what should you be charging in your fees? And this is portfolio related, buying and selling portfolios. This is a money chat. So if you're putting these types of portfolio deals together and you're speaking to the agents, you're viewing the properties, you're running the numbers, you're doing the due diligence, you're managing the investors, you're managing the buyers in many cases, then to put it very frankly and very clearly, you are the glue of this entire scenario. So here's the truth. 2% is not too much if the deal stacks and you have done the legwork. 2% of the buying fee, or 2% of the overall fee. You're not just selling houses here. And this is important. And I think this is more than a tactical, practical strategy. This will boil down to your mindset. And you need to get your head in the game here. You need to understand that you're not just selling properties. You're delivering a cash flowing, packaged together portfolio. It has already been risk assessed. It is fully teed up and ready to go to completion. The buyer in this process, your investor, has had fuck all to do. You are the glue. Some investors will try to haggle anyway. It's just who they are. But others won't blink. They will see the value, and those are the investors that you want to work with all day long. So here's my advice. Stick to your guns if the numbers stack. Stick to your guns if you've packaged it professionally. Stick to your guns if you've backed your fee with confidence. And by backing it with confidence, it will be doing all the things that we spoke about. It will be, you've been speaking to the agents. You've been viewing the properties. You've been running the numbers. You've done the due diligence. You've done the comparables. You've managed the seller. That's how you earn your fee. That being said, you can offer, and there are circumstances where you can offer a bit of flexibility. So you could use maybe a tiered model, 2% on the purchase price, or a flat £2,000, £3,000, £4,000 per property. You could also offer an early bird rate if an investor commits within 48 hours. Now, you can be slightly more creative and you can throw in what we would call an added bonus, like a free power team introduction or post-purchase support. But if you are offering a hands-off portfolio building service, then this will be included in it. There is one thing I want you to never do. Do not lead with discount. Do not, in most cases, entertain a discount. Instead, I want you to lead with value. The more confident and skilled you become at showing the value, not only of what you do, but what you're bringing them to the table in the form of these assets, the more skilled you become at that, the more money you will make, period. So if you want to build a reputation in this industry, within the world of sourcing, within the world of portfolio building, and not just flip a few deals here and there, then you need to know your numbers inside out. You need to present your deals like a professional. Remember, this is a business. This is not side hustle. This is not a hobby. This is a business. And if you want to earn business style profits from this, you need to treat it like that. Serious investors don't just want cheap. They want confidence. They want clarity. And above all else, they want cash flow. And that is what you're selling. In fact, you can take those three things and you can bake that into your marketing tomorrow. I'm giving you gold here. Real investors want confidence. Talk about it in your marketing. Real investors want clarity. Talk about it in your marketing. Real investors want cash flow. Talk about it in your marketing, because ultimately, guys, that is what you are selling. So if this episode has given you a kick up the arse and it's encouraged you to up your sourcing game, up your portfolio game, then here's what I suggest you do next. Go back over your past or your current deals and ask, did I lead with value here, or am I trying to win people over with discounts? Am I trying to be their friend by giving them a discount, or am I owning this professionally and leading with value? This is super important. If this has been useful, guys, like I ask all the time, if you're tuning in and you're listening back on YouTube or Spotify, take a screenshot, upload it to your socials, tag me. I am week by week trying to disrupt the world of property sourcing by busting through shite myths and giving you facts, not filler, week on week. But drop me a message on Facebook. That's where I hang out most of the time. Drop me a message. Let me know if this episode has been useful. And failing that, I'll see you next week.